What is up, everyone? How are you all doing? AGZ saying yo, what's up? Back to you. Brad Mills is in the house. Kevin O'Connor and Paul Vargas. Dinedale 66, all here hanging out, all ready for the pump and dump fest. How are you all doing today? I was just hanging out. Well, obviously you can't hear anything because I just now turned the mic on. So, anyways, let me give me 1 second right here. Our new Gullimer also chiming in saying, hey dude, what's up to you, fine sir? Paul Davidson in the house. All right, so here is the deal. I was just hanging out looking at some bike stuff. All right, I got a whole different setup over here, and I got my bike and the frame and all that, over there. And anyways, I found some really good rims that I'm looking for. The only problem is they're the wrong color. They're blue and my bike frame is white, like dark gray and kind of like a pinkish purple color, like a deeper pink into purple. And I was like, oh man, blue won't match, but they are like legit what I'm looking for. So let me know in the comments, does the color matter? Just rock the different funky color. They're like a brighter blue. So I mean, it'd make a different flare. I could always make the handlebar tape blue, but let me know. Trick is in the house. What's up to you, Trick? Trick's is top of the evening. Yes. Good afternoon here. Recovery drink because I have to run later. It's sprint workout. I already did a bike trip today. I did it on the old bike. Yeah, it was really fun. BZ says, got some spoke covers. Nice. And BZ hanging out. Support comment. Thank you. Moshaba in the house saying hello. At 2 p.m. is going to be the rate hike announcement. And then at 2:30, Jerome Powell will be going on the mic. See? Watch live at 2:30 p.m. Hey, there's a live look at DC. But yeah, I was looking at some rims, and like I said, the bike, the frame is legit, like color-wise and all this. Like it's really cool. Hold on a second here. The frame is like, ooh shit, I just hit my laptop. Is really light, but it's white, gray, and like a really deep purple. And it's super nice, cool carbon frame, but the rims I found were a blue. And were like a really bright blue. And I mean, they're exactly what I'm looking for. And it was a great deal. But it was just, they're blue, and I don't know, let me know what you guys think, mixing the blue up with that frame. Paul Davidson says switching to TV. Klaus, thanks, Paul, like that. But yeah, get some spoke covers. I don't know. I mean, you guys let me know. What should we do? All right, so what do we got going on right now? We've got some Fed stuff in the background. Crypto heat map right now. Look, we're expecting a pause, all right? 18 minutes away is the announcement. 99%, guys, 99% chance of a pause. So I mean, I don't know. Look, I think the action's priced in. I think what we have to consider here is that this is one of his summary of economic projection speeches. So if he's like, look, hey, we're gonna say screw this, not going to raise rates now, but we might have to one more time by the end of the year. Yeah, that could send the markets on down. Gunnar says functionality over cosmetics. Yeah, I know. I was thinking I could just add like blue handlebar tape, right, to match it. But it's the rims are exactly what I'm looking for. I can't run carbon rims out by me, so I have to run like the lightest weight metals that you can. It's just because some of the roads are really bad out here. And a carbon rim I'd crack. I've already had a flat going high speed on a turn where I've nicked a rim and I was able to file it out. On a carbon rim, that would have been cracked. That would have been a much more expensive repair. So, Glenn's in the house. What's up, Glenn? Good to see you here. BZ says, screw it, you're eccentric. Yeah, you're right. I mean, I worry about everything being perfect, being right, and except for the functionality of it, it's exactly what I'm looking for. It really is to the T. Crypto Bob in the house says, hi, all. Hi, Klaus. Finally caught you live again. Always a pleasure. Well, thank you, Crypto Bob. Yeah, we got a few minutes just to hang out here until Jerome Powell gets on the mic. 1:43. We got 17 minutes. I mean, look, the action is priced in right now. You're sitting at 99% chance. The biggest chance you had of it not being a pause and going to a rate hike was about a month ago. You had 11% of the people sitting there. Pumps and dumps. Yep, I know, that's the deal. Glenn says, if he pauses, I have a feeling we already priced it in because of the uptrend in the market the last few days. Yeah, and that's exactly what I wanted to bring up. Let me do that. Here we go. Let's bring this up here. And this is kind of, the other thing too is as we've gotten closer to this, we've seen that it's definitely been stuff priced in. So not just that, but look at this last little uptick right here. All right, yeah, okay, we know the pause. We've known the pause for a while, but there has definitely been some down pressure, and the down pressure there comes from the Torres pump. Just Know says, Agent Klaus, the main op of the Moon Boys. I know. I'm one of the worst spies out there. Simone is in the house. It's great to see you, Klaus. Papa JP definitely pumping the brakes today. Yeah, I think it's what he's gonna say, because think about this. All right, we're looking at the market, kind of picking up for a bottom from our XRP. XLM, let's kind of zoom out just a little bit. Let's go 3 month here. XLM still holding on to more Torres pump. Overall, the crypto market kind of... ETH hasn't had any love. Let's be real here, everyone. ETH has been kind of left behind. Sol is barely clinging on to $20, $20.22. Remember, Sol's got a lot of liquidation pressure coming down. So, Bitcoin, I mean, look, the miners, they've said it time and time again. At 30,000, they can make some money. All right? That's when the mining economy really starts firing up for Bitcoin. They said, hey, at 40,000, we're making gravy. So we're still not making money yet for the miners. We got to be close. For Sailor out there, his average was close to 29,000 and change for Bitcoin. So he's in the red a little bit. So a lot of the big holders out there are they're not making money yet. That's a good way to put it for you. Eric says, what's happening, people? What's happening with you? Just hanging out, really. Just hanging out, waiting to see what what Powell's comments are. That's my big thing. I'm also looking at parts for the race bike that I'm putting together. I'm switching to a carbon frame, and so I'm just kind of piecing together. Oh, I got my brakes in, actually. I got the brakes and the tires in as well for it. So, yeah, just waiting to get some chain rings and... Let's see. Well, actually, I could go single-sided asymmetric. But, yeah, just waiting to get some gear stuff in and hanging out and talking crypto. Trix says, get ready for the snakes in ladders. Giving a little charts action. Klaus wins the Open Tabs Award. Dude, do you see how many I got up here? I know, it's crazy. And the thing is, so these here are set up for a video that I was working on, but then, I kind of had to go live. But, yeah, this is a bunch of stuff going on with Stellar's upgrade. CoinEx resuming after their hack. Ethereum Futures Fund, and that's kind of what I wanted to talk about here, and I'm glad you brought that up, Easy, is Ethereum. That's one of my tabs that's up, is just Ethereum not getting any love. All right? Cool. Grayscale files the application for it, right? That's fine. I get that. But Ethereum itself, as a native asset, hasn't been, breaking 2,000 for a while. I mean, what are you getting out of Ethereum right there? I mean, you're not getting shit. Let's take a look at that. Just to kind of prove to my point. And that's what I'm saying. You don't even look at ETH that much anymore because it hasn't done anything big. Look at this. In the last 3 months, it touched 3,000 twice. July 12th, 13th. Hasn't held on since. I mean, what are you going to do with that? So, yeah, ETH is kind of soft. Dunder Mifflin himself, yes. No, today is the Adidas hoodie, so Adidas, if you're out there, please sponsor the channel. I would love that. Stephen Pike says, expect a 50 basis point rise just to spite us. Yeah, as he just grins his teeth and just starts gritting like this and looking, if he gives us with the 50, we're screwed. Paul David said, any feedback from the mainnet conference yet? Brad Garlinghouse and Stu already have a slot there. No, I haven't heard anything personally about it. John White says, don't spend too much money on your bike. It's nasty. No, the thing is I need a little bit lighter bike for all the hills that we got out here. That's the big thing. I need to get a little bit more light saving. So that's why I picked up the full carbon frame. I just got to get the parts on that. ETHgate having an impact. Look, ETH's gotten the golden pass. Let's be real here. ETH hasn't been touched. Their staking would be ripe with SEC action. Come on, let's be real here. come on, their staking would totally be, I mean, like, and the thing is, it's big. I think, what's the ETH staking minimums? 40,000 or 50,000? So, I mean, it's obviously it's big holders out there. So they're getting some protection here. Gensler doesn't really want to call out ETH. He did a little bit after, proof of work to proof of stake action. But ETH just hasn't been exciting. I mean, I don't know. It's a hard one to say, and the reason I say it is because Bitcoin is definitely holding value more so than ETH. After the ETH mining went away, it just went crap. And that was the whole thing. Once you took the mining ecosystem away, you were sitting there going, okay, well, what? Cool, ETH. All right, awesome. I mean, but it's not the same. You miss out on a whole ecosystem within that ecosystem, a whole driving factor. And the miners for Bitcoin really do drive things. I mean, watch when Bitcoin prices go above that 35,000 mark, watch how many more mining rigs are going to start selling. You're going to see the price of mining rigs change. You're going to see a whole bunch more people fire up their rigs because a lot of people, hey, it's just they're not making money now, so they leave them dormant. I mean, big changes happen. And that's kind of thing with Bitcoin, you see that incentive, that financial incentive. With ETH, you don't. It's not the same mechanism. I'll put it to you that way. Cannondale aluminum, fib rate, cost, benefit, negligible. Yeah. No, hey, rock on, man. I love the Cannondale. How many different coins do I hold? A few. That's a good way to put it. Let's see. No one goes broke taking profit. Keep up the good work. Yeah, thank you for saying that. And that was someone said that. I was watching a program and someone said no one ever goes broke when taking profit. And that's the whole thing. Like, so that's why ETH hasn't been exciting for me, because there hasn't really been much to play on ETH. I mean, there's a couple moves here, but come on, it's just, I don't know, it just hasn't been that alluring. It really just has not been that alluring. XRP is a lot easier to call. I mean, none of the moves hold. I mean, come on, the summary judgment one, we talked about that plenty of times when they filed for summary judgment. You get the Torres action here. I mean, we've known that hasn't going to hold. I mean, so. By the way, 2:30 is when Jerome Powell comes on to the mic. We've then got, at 2 p.m., by the way, will be the announcement, which will pop up. We will have his notes on here, the press conference statement, all that good stuff. Martin Ribbons, channel supporter, thank you much, Martin, says, what are your thoughts on ETHgate? I think ETH is just, I think ETH has protection in a way, but then, like, at the same time, I think there's big concerns with ETH. Like, okay, a lot of people, we talk a store of value on here a lot. Bitcoin as a store of value is very strong, right? If you're gonna put crypto on your books and you're gonna write down on its negatives, but you're gonna take, profits and sell, when you're up there, hey, that's all fine and good. But you notice more and more people, you hear about Bitcoin being put into their holdings. You're not seeing too many big players do it with ETH. A lot of people got burned using ETH as collateral too. There's a problem with staked ETH, all the wrapped ETH bullshit out there. ETH the stable coin. And it's just really weird. It's just ETH just doesn't do it anymore. So that's my big take on it. Gunnar says sinking ship anyone. Yeah, I mean there's always concerns, but the whole thing is fake it till you make it. And I mean they've got a money printer go burr system. I mean, think Justin Sun's another one with TRX and Tron. I mean, come on now. How much that dude's like self-minting money. It's crazy. Totally crazy. But that's the deal. So we've got a few minutes to hang out, 8 minutes until we get that rate hike announcement. But right now, I don't expect the markets to do anything big. Oh, speaking of big, big screen. Check it out. I got my training calendar. I'm doing 3 races right now so far. I'm trying to pick a 4th one. But my 3rd race that I'm preparing for and training for is going to be a 6-hour ultra run. So I'm getting my training ready, everything from brick sessions, running and biking and speed work and 80-20 crap, all that kind of stuff. So yeah, I'm going to be doing a lot more training, focusing on a lot more health. Trying to be like overall just really, really more focused on that. So Glenn also says a lot of fun with ETH. Very, very true. Let's see, here we go. Fox Carlos, I don't think you live with your wife anymore. She kicked you out or left you on your own terms. That's why you used the green skin. And also thinking drinking alcohol or taking an antidepressant. No antidepressant, no alcohol. I just seriously, like, once, like, there are things that, like, I find very passionate and you get to have excitement through it. Like, I really love doing this stuff. I really love complex problem solving and financials, and I love that kind of stuff. But how much fun is it to do financials when things are down? How much fun is it to do financials when you're looking at the user base and you're looking at the profits derived of user base, which is what most of these exchanges are dealing with? CeFi, DeFi, volumes themselves are just eroded, which means there's not as many players in the market and there's not as much money in the market. So yeah, trust me, I love this stuff. But sometimes the whole idea, it's not about being down. It's about, look, I can dissect it from a financial angle, and I'm going to say, hey, this is really bad. And this is really bad because X, Y, and Z. And I'm not going to sit there and go, oh, it's bullish, we're moving trillions. No, we're not moving shit now because a lot of money is just way too expensive. There's too much risk on the table, and we don't have the clarity. Messi Leo says, like live. Yes, please like the live. Jimbo Tango in the house. What's up, Jimbo? How are you doing? Jan's in the house as well, saying, what's up, Klaus? Good out in dear States. Yes, hanging out in the States. But no, I mean, that's the big thing. Oh, the other thing we're talking about here is, give me a second. The other thing we're talking about is I've got the carbon frame that I am working on right here. I've got the brakes already for it. I've got the tires. I found a set of rims that are perfect for this. This thing is really awesome, by the way. Like, this is, like, really, really cool. But I found a set of rims. They don't match. They're blue, like electric blue in color. But they're perfect for what would fit the use for this bike. And I also have, oh yeah, I've got my stem too. I've got my stem, tires, and brakes already for it, in the fork. So, yeah, but let me know what you think. Should I just say screw it and get the blue, or wait until I find black rims that would match it much better? Hoover the Fud Killer says, evening from Sweden. Roscoe says, ETH is junk. Yeah, I'm not a big fan of ETH. I mean, seriously, we were talking about that, ETH. I mean, where's the love? Where's the last time it's been since ETH has been at the 2,000 mark? I mean, we're talking all the way here, July. Mid-July. Hans says hello from the Netherlands. Hello back to you from the States. From South Carolina, by the way, where the weather broke. But yeah, I mean, there you go. You had 2 days here where ETH was above 2,000 in July. Yeah, it's not much fun action, you know what I mean? You think Brad Garlinghouse cycles? It's way overpriced. Yeah, I mean, honestly, I think the whole sector is way overpriced. I really do. And I gotta say, I think global markets are still overpriced. I think there's still too much money floating around up top. And that's where the big overpriced action is coming in. All right, I see that more than anything. It's not like your middle income, lower income, working class. It's nothing like that. It's the up at top. They still got way too much money for way too much stupid shit. And I think that needs to dry up first before the real corrections happen. Netherlands, the motherland. Get blue tires. They will look cool. Yeah, they're electric blue rims with black spokes. I mean, I don't know. I mean, there's nothing blue on this bike. I can make the handlebar tape blue on my aero bars. Yeah, I don't know. I mean, but they're functionally exactly what I'm looking for. I don't want to run carbon rims because they would crack by me. They would just totally crack. Brian XRP says, up from Wrightsville Beach, North Carolina. Not too far from you. I'm from the upstate in South Carolina. Diego chiming in, channel member. Thank you very much, Diego. Says, greetings from Elmere City, the Netherlands. Thank you very much, sir. And Diego, seriously, I was just sharing. I got my training log set up, you know, and your post is reminding me about the whole thing. But I've got this set up because I'm doing a 6-hour ultra race. And the 6-hour ultra race, for me, this is going to be 16 weeks of planning. Yeah, 16 weeks of planning. Eric says, Klaus, you want a downer today or just not feeling the market? No, it's not that. Honestly, I'm seriously very, very worn out from my trip to Colorado. I am very, very worn out. Like, seriously, I am extremely worn out. This was rough. I hung out here for over a week, and this really beat me up. I was up at altitude a lot. The camp was at 9,200 feet. So, yeah. But, yeah, we've got Jerome Powell rate hike announcement coming out here. We're expecting, obviously, them to stay neutral here. Diego, yes, 16 weeks. Yeah, it's 16 weeks because it's a 6-hour ultra. So you basically run as far as you can for 6 hours, and how like the winners are determined by how many miles you do during those 6 hours. So Glenn hanging out from the Netherlands. Hi, down to earth it is. Yes. All right, waiting for the rate hike announcement right here from Jerome Powell as soon as 2 o'clock hits. Prepare for Walhalla, brother. Hey, dude, I'm totally getting ready for this one. Cleaning up the diet a little bit. I'm still training with the bike, so I'm still cross-training, doing my duathlon training, but I'm really going to be bumping up my endurance. We're talking 3-hour runs, training with speed work. I'm doing track sessions. All right, here we go. We've got Jerome Powell's statement. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity. Whoa, hold on a second here. There we go. The committee remains highly attentive to inflation risks. The committee, in support of these goals, the committee decided to maintain. So they took a pause. The committee decided to maintain the target range for the Fed run rate at 5.25 to 5.5. The committee will continue to assess additional information for its implications of monetary policy. So, yep, there you go. Took a pause. That's the deal. Jerome Powell took a pause, man. That's the deal. Hold Stratters Link says, Klaus, your trip looked incredible. Yeah, the trip was the trip was really good. It's rough, but so no, I'm the reason why I am so worn out is because of this. Like, this was the terrain that we tackled, and my dog ended up getting hurt on the trip, and she got hurt, and I ended up having to carry her, and it really, really wore me out. And yeah, there was still snow up there, and this is snow from the previous year. This isn't fresh snow. So yeah, no, it was just a really rough trip. So that's why I'm kind of I'm worn out. I'm worn out because I came back from Colorado, and I right away got back into training. So for me, it's just right into it, nose to the grindstone. Mark Sintic dropping a donation super chat. Everyone give Mark a big thank you. Mark says, keep up the good work, friend. Well, thank you, Mark. I greatly appreciate it. Yeah, I don't mean to be, I'm not down. I'm seriously very tired from my trip. That trip wore me out. I had to carry my dog 5.5 miles. My dog is not the lightest. She got hurt on a scree field and scraped her hind legs up really, really bad on like fresh rocks. So basically what happened was it snowed so much at altitude that when all the rocks broke, when all the snow started receding, like it was all fresh, just like sharp, jagged rock. So there was a part that she slipped, and when she slipped, she laid flat, and it kind of like cut up like the insides of her legs and her paws. And on her way down, she was still doing good, except she started cutting trail because she was getting tired. Well, she cut trail onto a part that was fresh, and when it was fresh, it fell again. She fell with it, and so yeah, I had to carry her. It wasn't fun at all. Trick says, yes, giving Mark a cheers. Crypto Bob giving a well done, Mark. Trip to the Moon says, hope your doggo is okay. Yeah, the dog, she's doing better now. Like she can actually physically move is a really good way to put it. Here to show you, this is her paws. These were her paws. They were all banged up from falling, and let's see here. Give me a second here. I've got a picture of it. You could see, yeah, like these are all cuts and abrasions on her paws. Like you could see it all throughout here on the skin. I mean, she just caught everything. So, yeah, I mean, it was a very, very rough trip. The weird thing is she didn't give me any signs. She just, I mean, she fell. I mean, that was plain and simple. She fell. It was kind of it was a rough one. So going up, I took tons of pictures. On the third summit, we did 3 summits that day. On the third summit, I had to bring her up the summit and then all the way on back down to the trail. It was 5.5 miles. So, yeah, I'm still just kind of beat from that. Jan says, use Shimano stuff, 105 gear and ride 82 millimeter tires. Well, this is going to be set up, holy shit, 82s. This is going to be set up for my duathlons. It's going to be my new duathlon road bike. So I'm going to run like 28s, probably at the, maybe 30 at the most. And then, but the whole idea is I want it to be really lightweight for hill climbing. So, but yeah, having a German Shepherd, that not that light, that would zap everything in the energy. Well done. Yeah, it was rough. It was not fun at all. The market though is hanging out here, 27,000 for Bitcoin, E 1626, XRP hanging out at 51.8, XLM right now sitting at 11.7. We've got, where do I usually see it? Where is, hold on everyone, XDC, there we go. XDC sitting at 5.3 right now. So yeah, I mean, that's the deal. We knew this was going to happen with the market. Next thing that's coming up is going to be Jerome Powell coming up on the mic. Jerome Powell comes up at 2:30. So yeah, please don't take me. I'm not like, this is not me being negative or anything down. Like, I'm just seriously, I'm still very, very tired. That trip really did it to me, and it usually does. A trip I did about 3 years ago, I fell a good 20 feet. I had rock fall, and like, so I literally slid down, grabbing anything I could with my hands. I couldn't like hold anything with my hands normally for like a couple months. It was that bad. But this time it was her. She fell on something that gave way. So yeah, I mean, we're back. We knew what to do. We made provisions for it. So I'm just really tired from that trip. So don't take it as me like not interested in the market. I'm just physically very tired and kind of mentally tired from that too. So yeah, that's the deal. Jerome Powell's got his statement here, and the statements, by the way, are all linked in the description down below in this video. And that's also too, when this video is over, if there's a part that you miss or if you got to go somewhere, this video will be in the live stream folder, so you are welcome to see it. Glenn says, just take an adrenaline shot. So yeah, that was the thing with the trip. So I felt fine. I mean, like, not fine, like my legs hurt just a little bit. My ankles got kind of beat up. But like, I felt good. Like, once my adrenaline wore off, I started getting worse and worse and worse every day. And I took about 5 days off and just did like really not much other than walking around doing mild laps just to give my body a chance. Cause I even felt like horrible. Like, it was not comfortable at all. It was not comfortable. But yeah, so I'm back here. But the big news right now is Jerome Powell is taking a pause. He's saying that, guess what? The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remain uncertain. The committee remains highly attentive to inflation risks. In determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags in which monetary policy affects economic activity, inflation, and economic and financial development. So yeah, that's the deal. Basically saying, hey, look, the data is going to tell us where to go, and there is a lag time for the effects of rate hikes. Some of these effects there might not even be 90 days. Obviously, with mortgages and stuff like that, that gets hit right away in the next cycle. So stuff that's locked in is there, but your next 30, 60-day cycle, you start seeing more and more at that higher rate. Auto loans, those things flip quick. So yeah, there's definitely a lot of markets that get mixed up with this. Scott says, Gensler in front of Congress on the 27th. Probably just a shit show to make it look like they're doing their jobs. Yeah, you know, we might cover that one. We might cover the Gensler one. Let me know in the comments if we should. Tricks has caused to put me to shame. If I could get my car up the stairs next to the bed, I would. No, it's you do what you got to do, and luckily I was in shape. Luckily, doing all the duathlons and stuff like that, and the races, the running, I was in good shape to kind of pull that off. Not that I wanted to, but I was capable of doing it. Fed Jerome Powell will be coming on the mic at 2:08 right now. At 2:30. Sorry, it's 2:08 right now. So we got 22 minutes to hang out until Jerome Powell and the Fed come up. So this is up to you. What would you like to talk about? What do you got on your mind? This part of the show is for you until Jerome Powell comes on. We got 22 minutes to hang out. Let me know what you would like to cover. Let me get a quick recovery drink here. I still got to run later today. Let's see. Eric says, "Take care of yourself, buddy. I think you might be going a little too hard in the paint." No, I'm definitely on the recovery path right now. I'm definitely feeling way better every day with my trip. It does physically really wear you out. But that's the whole point of doing trips like that, right? To test yourself. Not that you want to test yourself that way, but you got to test yourself with everything. Glenn says, "Powell talk a lot without saying something interesting as always." Carlos says, "We pumping and dumping." I don't think this is going to be news to pump. I think the Fed, here's part of the problem. The Fed has to deal with this. Since June, we've actually gone up 2 times in a row in inflation readings. Housing is still high, and gasoline energy went high. And we know gasoline energy is going to be high this time too. So I think you're just stuck with Jerome Powell thinking, look, if we raise rates, is it enough? Did we raise it enough already? Is it going to take some time for these effects to be more permanent? Because otherwise, here's the problem. If we keep getting used to like 3.74, that's not good either. Yeah, it's way lower than this 8.2, 7.7, but it's way lower. Let's see. Coconut Monkey says, "Klaus, if XRP becomes used, do you think of all the millions of transactions happening daily of fiat going into XRP for a few seconds will blow the price up like a balloon while it's running?" I don't think so, because it's still going to be supply and demand on the open market. So okay, here's the thing. Used for transactions, used for settlement, used for payments are totally different things. Right? The more something is used as a payment, right? The thing is, they're clearing that money fast. But payment, one thing, all right, even better than that, store of value. All right, how much is being bought and held as a store of value? Carlos Rodriguez drops in. Everyone give Carlos a big thank you for that. Thank you very much, Carlos. So yeah, I think it's here. If you're using it for payments, you can do these payments quickly. That's kind of the benefit of it. Store of value, that locks that up more so over time. You'd be having to do a lot of payments. A sick amount of payments for that to put any sort of leverage on there. Especially if they're clearing it through. I don't know. I still think store of value is the better play. I do. I still think store of value have a better chance than transactions here. And I think you have a lot better chance with that. Eric says, "We need to raise these rates. He's dragging this recession for far on too long." Yeah, I'm right there with you, and that's why this is what I'm worried about right here. Is if this starts going up, okay? The big economic problem you have is that if this goes up, right? If inflation, this is like globally, we're seeing this mess everywhere. If this goes up, that means we're going to be normalizing high prices. When you normalize high prices, you set the stage for more inflation, not fixing it, but increasing inflation. Again, you don't want to go back to now prices going freakishly high. That's just not what you want right now. So I don't know. I've always been in the mindset of he had to have been aggressive earlier. That when we look at this, that he had to have been aggressive much more earlier around this time. Because we all saw it coming up, and we felt it at home faster than they felt it in their reports. So I think the big problem was, A, he didn't hit it soon enough, and he didn't hard enough. Yeah, he came up with the 75, 75, 75. That's pretty freaking hard. I don't think anyone else could have said, like, hey, look, come on, 375s in a row is huge. He just didn't do it soon enough. So it's almost like, hey, you know, we've heard the train has left the station crap. It was like inflation train left the station. And what happened was, when that inflation train left the station, price was just even getting nasty. Moshtaba says, bro, don't even joke about getting used to it. The way that things are here, I might have to move back to my country, which isn't a safe place. And Moshtaba, you're seeing the same thing here. People moving into places that aren't as safe. Why? Because it's more affordable. And that's what's happening around. That's what I said earlier. The working class, middle class, they're pretty much tapped out of their reserves. It's the elites that still have a lot of money. Glenn says that's why they had to crash everything earlier. Then prices must go down because no one could, the higher prices. Yeah, and who could handle it, right? Now here's the big problem. You've got all this right here, right? This nasty inflation, right? Prices are still freakishly high. Let's be real here. They're up 4% from a year ago. All right. Yeah, so they're still up from an up year on an up year. That's not a good trend. All right, that's going on 3 years in a row. That's a very bad thing economically. So yeah, he should have hit it sooner. I'm not going to say he should have hit it stronger sooner because the first hits were really strong. But he should have definitely hit it sooner and not let this bump right here, because this came up quick. And then this spike right here, this worries me because we were in a pretty good free-for-all. Then all of a sudden it's like, now look, we got to take more. Coconut Monkey says, Klaus, if XRP becomes mass adopted and banks only need to hold XRP instead of a basket of currencies for liquidity, where does that value come from? Well, then again, look, if they're holding money in terms of a value in a basket, store of value. That's what store of value is. That part of banks holding on to something, that's a store of value. That's the best way to put it. Because think, just because banks get cash doesn't mean they hold it in cash. No, they trade it off into bonds. Sometimes 3-month bonds, sometimes 6-month, sometimes 1 month if they just want a quick turnaround. They don't just put their money there. So everyone uses money, for something of money. And so, yeah, I get what you're saying. But that's store of value, though. Glenn says, do you expect another big crash before things get more bullish? I guess what concerns me is if we get another high rate like this, right? Another CPI, bad inflation data, and it's all over the world. It's been really bad. Let's just be real here. But we get another one that comes up like this. What worries me is that he won't have to come back with a 25. He'll come back with a 50. And right now, you still don't have homes on the market. So the housing is still messed up globally. Also, globally, we've got a huge credit problem. So here's the problem. If you have more people in default credit-wise, and this is for housing, this is for cars, this is also global credit cards, right? These are all global things. If all three of those now get hit with even higher rates, that means all the interest people are going to be paying on new versions of those or ones with flexible or variable rates, they're all just roasted with another quarter. That's not good at all. So you've still got a very big credit default coming. Now, what kind of credit default that's coming? Well, pick your poison. Cars, homes, credit cards. I mean, you're going to see a whole bunch of them. So the money right now, or what the idea is, where the big plan for money is, you're going to be able to buy things of that nature for 60 cents, 50 cents to the dollar here in the next couple years if you've got cash. So people are looking for that store of value, right? They want to make sure that their cash is not risky to any sort of monetary issue. So they diversify. They put some in this, some in this, some in this. But they're keeping it short term, close to them at the moment, because a year to 2 years away is not that bad. Not that bad at all. Diego says, try it. Housing sucks at the moment. All in the name of greed and free market. Yeah, it is. It's in inflation and housing is going to keep getting worse because private equity groups got a whole bunch of money when the Fed fund rate was next to nothing. So they've stacked up. Barno's in the house as well. What's up, Barno? How's it going? Good, sir. Glenn says, well, if inflation next month goes higher, Powell needs to hit us with the 50. Yeah, and I guess that's the thing. Like, he should have hit us not with more sooner because it was 75s right away. He should have hit us sooner, but then he should have hit us maybe with a few more 50s. I mean, because honestly, we saw it. We knew this pain, and we talked about it on this channel. Everyone kept saying, remember, seriously, how many times was I roasted for saying that housing was not going to crash? I kept saying, I said, housing isn't going to crash. Private equity groups are going to prop up the market. It's going to make it way worse. And everyone kept saying, no, Klaus, housing is going to crash. Housing is a bubble. Well, guess what? Here I am reporting on it 2 years later. Housing has still not crashed. Housing doesn't appear to be crashing. There's no inventory out here. The rental market out here now is starting to get priced in even higher because there's less options available. Trick says, in my opinion, the whole lot is going to go tits up in 2024. Yeah, something has to give credit-wise. And that's what I'm saying. So if all these credit defaults start happening, and they're within credit cards, car. Okay, how many people bought a car here in the last 12 months that when they go to sell their car, trade it in, they're now going to be flipped for a shitload because the car is just not worth that much? There's going to be a lot of people hit with that. So the whole thing is if you've got cash, you could then buy those assets, wait it out, and then flip it for way more. Look, there's still a huge demand on cars right now. There's still a really huge demand, certain premium for certain types of cars. If you're able to get some credit defaults, get some of those at 70 cents to the dollar, make a quick 20, 25 cents to the dollar after fees, dude, you're rocking, man. You could make that in a short term. So you got to see where that money's happening. Housing right now. If you know that you can get housing defaults, all right, you could make some sick money with that. Even if you can't, you put a ridiculous price on your home, right? You buy something that needs a little bit of work, you put a ridiculous price on it. Even if you don't get your ridiculous price, you know what you do? You're able to rent it for a ridiculous amount of money. What's your risk right there? And then you get it ready to sell the next year. I mean, that's you're seeing people getting ready, putting cash to the sideline for a big play. All right. So yeah, I could definitely see the markets going down. Why? Because there's a vacuum of money. The reason there's a vacuum of money is you are starting to see more players stack cash on the sideline, getting ready to make some hits. I've been talking about how I've been seriously very cash strong here recently. Very cash strong. Any profits that I'm taking on short-term action goes into the cash pool. Goes into the, hey, guess what? There's going to be a county real estate auction. Let's go to it and see what happens. Oh, you know, there's an estate auction, you know, where they're doing multiple lots or something. Cool, let's take a look. Maybe we could get a good deal there. I mean, so people are doing it because we know there's going to be some deals. Now, is it going to be this auction this year cycle? Ours is coming up in a couple months. I don't know. I don't think so. But maybe next year's might be juicy. Maybe 2024's might have some juicy stuff. Trick says, I've got no crypto at the moment. I'm watching and waiting. Yeah, and that's my thing is there's so much more action right now that you can make money on, where I think a lot of investors are getting ready for that. A lot of investors are sitting here on the sideline stacking cash, getting ready. Eric says, I think they're just dragging this thing on. They know everyone is holding cash waiting on the drop. They want us to dwindle our savings. And yeah, I mean, I don't think it's a them versus us as much as this one is more about there's so many opportunities out there. Like, you just have to find an opportunity that you know someone else wants. All right? That's the whole thing. You have to find an opportunity that someone else wants. So if you've known that, or you know that auctions are going to be hanging out, and you could make good money, buy things at 50, 60 cents to the dollar, flip it quickly for 30-cent premiums, come on. You do that all day long, you could rinse and repeat that shit. So you gotta be prepared, because a lot of people are doing exactly that. Captain Cornship says, I'm sitting on top of 0.03% XRP just waiting for something to happen because I can't trade. Yeah, I mean, and that's the other thing too, is trading is not for everyone. But right now, I'm going way more cash heavy, getting ready for auctions, real estate sales, estate sales, county tax auctions, like anything out there that's real estate related, anything like that, where you know, hey, even if you can't sell it, you could rent it and make yourself cash right away. That's a no-brainer right now for people. And that's the whole thing. So if you have cash, you can circumvent having to pay the high interest rates, which means now going against any competitors in the area, right? You could take 10,000 less on the sale, 15,000 less on 20,000 less on the sale. Why? Because you got it in way cheaper. You paid cash. You're not worried about paying interest every month. So, yeah, it's you just got to be careful. You know what I mean? That's the whole thing. And Diego's got to leave. Sorry, sadly. Everyone, give Diego a big goodbye. Thanks, Diego, for hanging out with us. I totally appreciate the support. And yes, 16 weeks, man. 16 weeks. I'm gonna end the year with a 6-hour ultra rate. Glenn says tokenized real estate will be booming. Yeah, the ways they could put more access to people, but I'm looking for like full out control. I mean, like, and that's, you just have to think of what's available to you. Diego says, Klaus, get some sleep, man. Stay old school. You better believe it. Thank you, Diego. Yeah, I will. I got a run workout I got to do after this live stream, but I definitely should be fine because I've got quite a bit. Like I said, I've got a 16-week plan set up here. I already lifted yesterday. I ran yesterday. I already did the bike today. I just got to run later today. So Klaus sounding like he's about to get some Z's. No, it's not. It's not that. It's seriously, I am. I'm worn out from Colorado. I am. I'm really mentally. It's for me. I think it's more mentally. I'm mentally worn out from Colorado. I noticed that Colorado took a lot out of me. Like, it really physically did. I got to totally be honest with everyone. It really, really drains, and it drains me every year. But it's very cathartic, and I learn a lot of things. I learn things about myself differently each time, so it's totally worth it. All right, Diego, thank you very much, sir. Thank you, everyone, for giving Diego a goodbye. We've got 5 minutes until Jerome Powell comes up on the mic. So it is up to you. You've got questions, you've got comments, you've got 5 minutes. Bring them. Coconut Monkey says, I'm DCing into crypto right now, buying the dips, stocking up for the bull run. Also, physical metals increase, it goes under. Yeah, I like it too. I like it. It's you got to diversify, and you got to know too. Whenever you do diversify into something, what's your exit strategy on it, right? What do people like? What's going to be the want, the demand of that, and that, you know, how liquid is it? What does the demand seem like? Fern 5 says, "Sup, Klaus, sup to you, Fern 5." FedOx says, "Good time for coffee." I have not done any caffeines. I've not done any sort of stimulants, nothing like that. I have like completely been detoxing, just doing this thing right since Colorado. Extra hydration. I was up over 9,000 feet for well over a week. And I huge chunks of time over 13,000 feet. Huge chunks of time. Bill tags, what is we thinking that they're doing? Well, they took a pause. They announced it. They did. They took a pause. We're just waiting for Jerome Powell to come on the mic to tell us how bad he thinks it's going to be in the future. So yeah, that's what we got going on now, and that right now is going to be happening in 4 minutes. Jerome Powell and the Fed. But what he's got to worry about is this right here: inflation jumping up, and honestly, prices at the pumps going up yet again. Come on, talk about pumps and dumps. Klaus, are you holding in Stronghold? I heard is that XLM's railroad while SHX is on the train. I am not invested in Stronghold. I am not holding that at all. Thank you for asking, Sniff. Coconut Monkey says, I think the Fed will raise this next time around. I think we'll hit 6% by the end of the year. 6% would be pretty aggressive. Give me a second here. 6% would put us at 2 more rate hikes, touching that, so that'd be kind of rough. Eric Kiki says, holding money market right now and waiting on stocks to drop, low risk and getting good rates. Yeah, Eric, that's kind of the thing. I believe the stock market is super overvalued as well. I'm a firm believer that the stock market is way overpriced, man. I think a lot of things have to really come down. Glenn says, Klaus, maybe take 3 teaspoons of black seed oil, works very well for the body. No, it's just I'm just worn. Like, seriously, it was a really rough hike. I mean, where we went was way up there. and even my ankles just took an absolute beating. I mean, it was just an absolute beating. And to give you an idea, this is the what we ended up going through, and so then we ended up coming back, and yeah, it was just a very, very rough. It was not an easy hike at all. Not at all. So yeah, we've got Jerome Powell coming on the mic in 2 minutes. I've got that up on the screen right now. We're just hanging out, and so far, what has everyone thought of the green screen? I know I'm not using it right now. I just got his regular background. But are you digging the green screen action in the videos? Are you digging the different vibe, a little bit more techy? I'm doing a little bit more in the overlays with the edits. Let me know in the comments down below if you're digging the green screen. And if you are, hit that like button. It helps out quite a bit. But yeah, we are waiting. Jerome Powell right now. Not expecting the market to do too much, but definitely going to see what the heck is going on with his future talk. Crypto and Stuff says Ripple definitely doing an IPO with all the YouTube ads to buy stock in them early. Yeah, I think the Ripple IPO would be an interesting one, because then you would get a full look into their books. That'd be very, very interesting. Trick says apple cider vinegar always works wonders. Green tea. I've been big on the green tea, man. Seriously, no, I do. I just need to recover more. It was seriously, it was a very rough trip. It was, and not only that, it's a 1,800 mile drive one way. Where we stayed and where we had to go hiking was the Cinnamon Trail, and that was an absolute disaster. I hit my exhaust coming out of a rut. Like, it was not fun at all. Coconut Monkey says green screen always adds some flavor. I appreciate that. Ooh, Jerome coming up onto the mic. Here he is. I'm going to go silent.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. It is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and you know, we're seeing progress, and we welcome that. But you know, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, you know, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, you know, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that, people just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the model and that the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase. And, but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Tamaros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think Confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can, for now, decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage.
This year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina?
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. In the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil?
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way we have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect, over time, a sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise.
Okay. All right.
I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5. What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening that becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right, you can look at just monthly readings and see what the increase was from the prior month. So you're right, when you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible, if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. what is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, And you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be, but I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
All right, there you have it. Jerome is done. All right, so let's kind of recap everything that Mr. Jerome Powell himself is saying. Basically, it's this. We're going to wait till data comes out, inflation, blah, 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 to determine raising rates. Now, what he said about the economy being good was very interesting to take away, saying, hey, families out there are complaining about inflation, but they can weather the storm. And that's why Jerome Powell said, hey, look, the economy is still strong. And that's what I was saying in the chat, is if you have a home that you bought a few years ago, if you have debt that's manageable and you're not adding more on a high interest rate credit card, if you don't need to buy a new car right now, you're going to weather this storm quite easily. But how many people is that? How many people is that not? So when Jerome Powell is saying, hey, look, the economy looks good, the reason he's saying it looks good is because people can afford this. Again, they don't like inflation. They don't like dealing with it. So it's like, not so much fun. Now, what we have to start taking away from this is if Powell is like, look, we can hold this on for longer and longer, that's going to put more pressure on middle and lower income families that are already living paycheck to paycheck. Or families as well as companies that are living, quote, paycheck to paycheck are having a hard time to do this, because if something comes up, they got to put it on a credit card. That credit card is going to be an expensive bill. Why? Because rates just get higher and higher and higher. So that eats up more cash, right? But again, if you have your home, right, your loan's more manageable, you can manage your debt, you're going to weather this storm. People that were not prepared, or people that are forced to spend large chunks of money here in the short term, are going to have some expensive bills that they're going to have to deal with. Double nothing burger with cheese. Yeah, and what he's basically saying is that he is expecting high rates like this for a while, right, to curb spending. We don't have to keep raising rates, but these are really high rates compared to what they were before. So high rates for a while, and he said families can absorb it. Families, their balance sheets are strong. Families can totally absorb it. So that tells me that the Fed isn't worried about raising rates. They're not worried about hurting the economy. They're sitting here going, hey, if we have to, we'll drop a 50. If we have to, we'll drop a 25. But families and banks are strong. Because remember, it's not just families. He said banks are strong too. So as long as there's good credit lending facilities, then you're okay. Let's see. Songbird and Flare. Yeah, I'm not going to touch that one. But no, I mean, what are your thoughts regarding this? I mean, honestly, what we heard a lot of from Jerome Powell today was a lot of him basically saying, look, the data is good with some things, bad with others, but the good is outweighing the bad. We don't want to raise rates too much and totally choke the economy. We want to let the economy grow as long as it can handle this pressure. The hard part is, though, is that means for people like you and I, life just becomes more expensive. That's the fact of what you're watching right now. Anything that you do, you pay week to week, is going to be more expensive for you. So, in terms of crypto being moved by retail, how? You're going to have, again, retail money, housing money. They can't get housing under control. That is just eating up all the extra money. What about student loan debt? Credit card debt, auto loans. It's a mess, everyone. It's totally a mess. So let me know what your thoughts are. Otherwise, we're going to be shutting down the stream here pretty soon. I do have another workout that I got to do. Yes, getting ready for an endurance race, a 6-hour ultra. So I got to run still today, get a little bit more of the calories in. But let me know what's on your minds, and then we will start calling it quits. But otherwise, I wanted to say thank you to everyone out there that donated to the channel during the stream. I greatly appreciate it. Jeremy Touche, thank you very much. And yes, I will definitely make a video going into more in depth about what this all means with the economy, help and explain it to all of you. I will be glad to do a video like that because, yes, some of this does get confusing. And some of it, you know, hey, it may sound bullish, but then you're like, well, wait a minute. How is the economy doing good a bad thing? And I'll make sure I share that with all you. Adroba says, thanks for your time, Klaus. Thank you much, Adroba. Like I said, I'm not leaving just yet, but I'll be leaving soon. So get your questions, comments in right now before we head on out. Like I said, got to do another training session. I got to make sure I drink my recovery drink. Eric chimes in and says he basically said the American household can afford to take these hits, destroying the middle class. Not just destroying the middle class, but now putting the lower class in a further poverty hole, which taxes the governmental system again. You are very welcome, Brad. Ben Q says, got your back, Klaus. Thanks for your time. Time to work out. Yes, it is. I got to get my speed workout in today. Totally, yeah, definitely time for a workout. I got my bike workout in earlier today. Now I got to do a running session. It's a speed session. I did a lift yesterday along with the bike. I'm sorry, a lift along with a run yesterday, which was a lot of fun. So I'm doing pretty good with that. Jeremy says, right on. Thanks for your support with the channel. Yes, thank you, Eric, for the thank you on the support. Trick says, nice one, Klaus Lante. Thank you very much, Trick. You know I appreciate it. As long as your last name isn't Schwab, I'm cool with you, Klaus. No, I am not Klaus Schwab. I am the good Klaus. But let's do this. Let's just chill it out. Let's just end with this. Let's end the stream right here. So if you guys get any last questions, comments, anything like that, what I am going to do is I'm going to end this right here. I will be in the chat. I will catch you cool cats all later.